From barter to bills, a short history of money. For millennia, humans traded goods and services directly. This was the age of barter, where the value of an item was determined by what someone else was willing to trade for it. Imagine the complexity and effort involved in finding someone who wanted what you had and had what you wanted. This system, called barter, was inefficient. Imagine trying to trade a cow for a haircut. The process was cumbersome and often impractical, leading to the need for a more standardized medium of exchange. Eventually, societies developed commodity money. These were items that had intrinsic value and were widely accepted in trade. These were valuable items like shells or salt that everyone agreed to accept as payment. Commodity money made trade easier, but it still had limitations, such as perishability and difficulty in transport. As trade flourished, metal coins emerged. These coins were made from precious metals like gold, silver, and bronze, which had intrinsic value and were more durable and easier to carry than commodities. These were more durable and divisible than commodities. Coins could be easily counted and stored, making them a more efficient medium of exchange. Paper money came later, representing a promise to pay in gold or silver. This innovation allowed for even greater ease of trade, as paper was lighter and more convenient to carry than metal coins. Today we primarily use fiat money, which has no intrinsic value but is accepted by governments and people as a medium of exchange. This fascinating concept has evolved further with the advent of digital and electronic money, which we will explore next. Trust makes the world go round. Fiat money is fascinating. Unlike commodities like gold or silver, fiat money has no intrinsic value. It's just paper or digital numbers, yet it drives the global economy. Governments and central banks issue these currencies, and people trust these institutions to maintain the value of money. This mutual trust is the foundation of our financial system. It's a shared illusion, but it underpins the global economy. Without this trust, the entire system would collapse. Every transaction, every trade relies on this belief. Think about it. The paper in your wallet has no inherent value. It's just a medium of exchange, a promise that it can be traded for something of value. Its power comes from our collective belief in the system. This belief is what makes the world go round, enabling trade, investment, and economic growth. Trust is the invisible force that keeps everything in motion. Central banking guardians of the money supply. Central banks are key players in the money system. They act as their country's bank, managing the currency and ensuring financial stability. One of their main tools is monetary policy, which involves controlling the money supply. By adjusting interest rates and buying or selling government bonds, central banks can influence how much money circulates. This affects inflation, interest rates, and overall economic activity. Think of them as conductors orchestrating the flow of money through the economy. Section 4. The Money Multiplier. How banks create money from thin air. Here's where things get really interesting. The concept of money creation by banks is often misunderstood, but it's a fascinating process that underpins our entire financial system. Commercial banks, the ones we use every day, also create money. This isn't about printing physical bills, but rather about expanding the money supply through their lending activities. They don't print bills, but they increase the money supply through lending. When you take out a loan, the bank doesn't give you cash directly. When a bank gives you a loan, it doesn't hand over stacks of cash. Instead, it credits your account with a deposit, which you can then use as you wish. Instead, it creates a new deposit in your account, increasing the total amount of money in circulation. This new deposit is essentially created out of thin air, backed by the promise that you'll repay the loan. This process, called fractional reserve banking, multiplies the initial deposit, creating more money in the system. Banks are required to keep only a fraction of deposits as reserves, lending out the rest. This cycle of lending and depositing continues, significantly increasing the money supply. Section 5. Why it matters: your money and the economy. Understanding money creation is crucial for everyone, not just economists. It affects your purchasing power, savings, and investments. When the money supply increases, it can lead to inflation, where prices rise. Conversely, a decrease can stifle economic growth. By understanding these concepts, you can make informed decisions about your finances and engage in discussions about economic policy. Money creation is a complex topic, but it's essential knowledge in today's world.